Hey everybody, Sean of Us to Live, and we are on episode 33 of our sneak peek for the week. And I just had to take a sip of my coffee because we've got a lot going on and I got to think pretty clear because it's going to be a busy one. And yes, it is true. Today is Monday. I am a little bit late on getting this out. Um, busy week ahead here. Aside from the Thanksgiving holiday in the US and a shortened week for the markets, we're also watching a lot of things. There's just a boatload of economic indicators that are going to be coming out. And I think it's just important that we have our hands around what could likely happen here. There's also this trend lately of a lot of the key stocks that were really rising fast seem to be coming down. Same thing with cryptos. There's a bunch of pressure on the market there as well. But I think the key takeaway here is this is going to be a very short week. I think we're going to have a ton of new economic data and earnings that are going to be coming through. I do especially think that things like inflation are going to be closely watched by most investors and traders out there, as well as what, if any, information we can gather from Black Friday from a sales perspective. And that's going to sort of give us our early view or sort of early warning, or maybe a good news too, I suppose, of what kind of strength we're seeing for shopping for retailers in general. So I just want to call it out. Thanksgiving Day is on Thursday. The markets will be closed and the bond markets will also be closed. Keep that in mind, depending on what you trade. And this could also sometimes mean reduced volume. It doesn't necessarily mean that's always the case, but you could see people out of work this week. You can see less movement in the markets or wider bid-ask spreads. So just things to be aware of if you're going to be active. And then again on Friday, the market will also close early. So keep that in mind. Markets are closed on Thursday. The stock markets will close at 1 p.m. Eastern on Friday. And then there's also a potential for the bond market to close early as well as on Friday at 2 p.m. So a couple of the key things we're talking about this week is really going to be around the personal consumption expenditure deflator for October. This is coming out on Wednesday from the Bureau of Economic Analysis. This is a bit different than some of the previous economic reports we've talked about. See, the reason we want to pay attention to this one in particular is what it does is take things one step further, and it's going to help to get us to understand just how inflation has evolved in the U.S. And I think that the real key thing we're looking for, and it's a warning sign, but it's something we want to be aware of, is are we looking at more elevated news on U.S., more elevated pricing on U.S. Price pressure? So this is to say, are we seeing more indicators of why prices will continue to inflate? I think this is really important. Now, just coming from the perspective of what economists are expecting, sort of the broadest measure of PCE has been 0.7% in October compared to September. Bloomberg compiled some estimates on this, and I think that what we're sort of expecting is about a 0.3% monthly gain to accelerate from September. Now, I want to call this out too, because sometimes I think when you listen to these indicators and these numbers, it's confusing. There's a lot of them. They're covering a myriad of specialized terms and situations within the market. So let me brass tacks this thing. All said and done, over the last year, this is the most we've seen it rise since 1990. So this potentially is a really big deal, and just yet another reason showing that things are starting to get to that point where they're becoming unaffordable. It's affecting the bottom line. For most people out there, it's helping to really decimate the chances of pushing or expanding those paychecks. So it's just a good thing to be aware of. Now, I do want to call this out that the core PCE is going to exclude certain things. So things like food and energy prices. And what it is it helps the Federal Reserve gauge the overall inflation minus those high volatility items. And we do expect it again to see a pickup in October. So I just want to call this out. Really simple terms. Since 1990, this is the highest and fastest we've seen it rise. This is a big deal. So this is just yet one of the many reasons we all really need to be paying attention to what's happening in the markets. And frankly, from my perspective, and again, as always, not financial advice, just my own portfolio and looking at my own holdings, I have some concerns. And I think that there's a number of things I'm concerned about. This is just one of the many. And I think that what we're primarily concerned with is as more people like myself, more professional investors and traders, more institutional funds, et cetera, continue to feel this pressure, this is where concern turns to action, turns to slowing down the economy, turns to slowing down growth, turns to reversing all of this. Not by any stretch. I'm certainly not saying by any stretch that this is definitely going to happen, but I do think that there can be consequences and reactions to it. If all of a sudden these things start to slow down from rising prices, and this is going to eventually potentially hurt the overall recovery we're looking at from an economic perspective, we start seeing it hit us in the pockets, and then it starts to hit retailers, right? So think of it in terms of how it starts to hit retailers. Now, when this happens, traditionally what will then happen is, we get what we typically call a faster than expected monetary policy tightening. And this is done by the Fed. And just more news, we know that Jerome Powell is going to remain as the chair of the Fed. So at least that's some consistency in thinking. Whether you like him there or not in that role, I understand completely, but at least we have an idea of how he's done things. So this is just really important to understand that with every reaction on one side, there tries to be an equal reaction on the other. And although we can typically look back historically and understand what it will mean for the results, it's just an important indicator to know that there is an equal and opposite reaction many times. If we stop spending and the economy slows, the Fed's going to do what they can to get it back on track. So just keep that in mind as well. And then the other thing I want to call out, just because there's a lot of economic data floating around, University of Michigan released their preliminary November survey of consumers, and the overall sentiment fell to its lowest level in a decade. And primarily, as you would probably expect, this is due primarily to the spike in inflation expectations that are coming down the road. So we're seeing this sort of great conundrum happening where inflation is pounding our wallets. It's making things very expensive. We're experiencing a lot of forced price growth in the markets and asset growth in the markets from this inflation. But the average person out there just doesn't have unlimited funds to keep buying more expensive houses, more expensive gas, more expensive food, goods, services, clothing, etc., whatever the case might be. So I just think it's worth noting here that, again, there's always an equal and opposite reaction. And I think it's part of our job as investors to understand what we do, what we take off the table. Do we move to cash? Do we take some of the risk off? That's a personal decision. It has to be based on your own cash flow, your own income, your own overall financial picture. Make sure you know what that picture looks like, where you have risk, and especially if you're leveraging margin, at any degree, but especially if you're heavily margined, these are the times you want to make sure you are clear on what the risk is and what would happen if a major event took the market down by quite a bit, frankly. So just keep that in mind. Now, the next thing I want to talk about here is we do have Black Friday this week. Black Friday, for those who don't know, is typically, or not typically, Black Friday is the day after Thanksgiving. And typically in the US and in a lot of places around the world, this is where people really go out and start to spend for the holidays, early Christmas shopping, etc. Traditionally, we get some good data that comes out, usually the next day, next week, next month, whatever the case might be. It starts to give us a feel from like a time variant position, so year over year, time period over time period, et cetera, to give us a feel for how people are spending, what they're spending on, which stores are getting a bulk of the spend. I have seen, obviously, like everyone else in years past, that spending is transitioning online more and more, but I can still track it back to the retailers. I don't know at all what's going to happen this year. And it's funny, I feel like oftentimes I have some sort of a feel. This is going to be a tough one. So I'm going to give you some of what I'm seeing out there from an analyst perspective, what the consensus is. And I don't know that I can even give an opinion because I don't feel very confident on any of it, if I'm being frank here. So I think what we are expecting is that there's going to be a better than last year pickup in end of the year shopping, right? And I think that what we're also seeing is we're expecting fresh highs. We think there's pent up consumer demand. And frankly, there's still a lot of folks who have been saving. This is, again, according to analysts and consensus. I know this is sort of a tough topic because there are a lot of people who are really struggling. But just looking at what the data is telling us is with the stimulus and with some of the things that have happened in the economy, there is pent up spend demand and pent up savings. So a big question is going to be really simple. With an unclear picture of where the money is going to be spent, a supply chain that's out of whack, stores that don't have staff, it's going to be interesting to see who takes advantage of this, which retailers can grab that spend, where that spend will be deployed, and how we're going to be looking at that long term. So I think there's going to be some additional issues here as well, right? Like we already know that inventory is affected by supply chain. We know that labor is obviously a big deal. I do also think that there's some reality to the fact that they may not even have the ability to mark things down necessarily like they typically do in years past, because they are paying more than ever for the products on their shelves. Those extended shipping costs, the logistics costs, the fact that they're having to raise wages, which, good or bad, ultimately does end up at the price tag. So the question is going to be, will people still spend if they don't get the discounts? And are the biggest players going to be able to offer the discounts that crush the small players? I think it's probably somewhat likely. Um, I also just in general want to see some other pieces that come out of Black Friday. We talk a lot about the retailers. We talk a lot about the shipping. We'll, of course, be talking about Amazon and the likes of them. I saw some other interesting things that I wanted to really bring up here as a note. A couple of stores up in my area were actually advertising that DoorDash will actually do some of these deliveries. I thought that was honestly brilliant because the last thing I would want to do is go to the mall to have to pick anything up on Friday. I'm not going to be a spender on Friday either way, but if I was, the thought of going to the mall, having it be completely packed and having to find parking, not interested at all. And I just couldn't help but think like, wow, that's so brilliant to have DoorDash as an option. And really now I'm looking at DoorDash and wondering, boy, what does that expanded total addressable market look like if now we're talking about picking up goods and not services, of course, but picking up goods that you purchase at scale? That's got me really thinking through like what other opportunities like that have I maybe not thought about, or where in the spectrum do I find opportunities like that across other folks too? So that's just a super interesting thing. The other thing I'm looking at as well is who's going to be handling processing and payments here. Are we looking at MasterCard, Discover, Amex, Visa? Are we looking at more people paying with non-traditional terms like Cash Apps, Venmo? Are we going to see any kind of an uptick in people leveraging crypto to spend money this year? I think we probably all know the answer to that. The answer is most likely no, but I still want to see if that happens. I'm curious in general. So those are really the big things I'm watching as well. I do want to say a couple things more on this Black Friday retail front. We've even experienced in my own household where we've gone out to look for things that were advertised in the catalog, for example, or we were told were in the store. When we get there, they never actually had them. And now they're telling us they're not even available. They won't be available for quite some time. So I do think that there's going to be some last minute changes in what people are spending the money on. They're going to have to make some shifts in gifting, maybe get some different items, just good things to be aware of as well. So a couple other things here as well is we're talking about some really specific things on Black Friday. We're talking about the market being closed. But what I do want to call out is, according to MasterCard, U.S. retail sales during the Thanksgiving week alone are expected to grow by 10% over the last year and over 12% versus the same week in 2019. So that, if nothing else, is at least a pretty good sign that there's some expectations of spend. And hopefully this means that there's enough margin to get people back in and working with good, solid pay that's going to get them what they need to be solid footing on their end as well. But I do think this calls to the very front and center of the room the fact that we have some major issues here from an economic perspective, a frankly country perspective in the U.S., where if no one can afford to live, no one can afford to spend. If no one can afford to spend, no one's going to be out spending. So the question then is, why do we keep seeing these economic indicators basically showing great news? Double-digit growth year over year, better growth over 2 years. So these are just the kind of things I'm really putting my eyes on a lot at this time of the year, is trying to understand that vertex of, well, so many are struggling in one area, so many other areas seem to be going so well. And I think that there's a coming sort of middle that has to happen here between all these different things from a political perspective, from an economic perspective, and from a global perspective, where we're hopefully watching as wages are growing. And we're also trying to make sure that inflation doesn't get out of control, because no one wants to hear this, and it's a really unpopular thing to say, but when you raise wages, inevitably prices are going to raise as well, because there's an awareness of raised wages, which means more margin to raise prices. If we can find a way for the Fed and the government in general to help sort of parse or hold down those growth rates within the inflationary period or inflationary products, et cetera, that's what we need to get to, is like wages grow faster than inflation will grow. This is where people end up happier. They can pay their bills. They can have a nice holiday season and spend on the things they want to spend. So I want to call that out as well. I don't want to go too into details on some of the specifics here, because I think I'm a day late in getting this out already, but let's just give you a couple of quick economic calendar things I'm listening to right now. So what we know coming up is we're looking at U.S. manufacturing PMI. And in general, I just watch this because I like to see what's being produced here. I like to see what we're looking at. What we're expecting, and this will be on Tuesday, is that we have an expectation of 58.7 against a 58.4 in October, so a little bit higher from the marketing PMI perspective. On Wednesday, we have mortgage applications. We have initial jobless claims. We've got advanced goods trade balances, we've got just an absolute load of details on Wednesday. The reason I'm sharing this, and I'm not going to go over every single one of them because frankly, there are a ton. However, we are going to get FOMC minutes, which is going to be really important from the November meeting. The reason I'm mentioning these in particular, this whole list of economic indicators, is when there's this many things happening over really a shortened week. So today being Monday, Tuesday, and Wednesday, there can be massive movements in the market if all of the data comes out, saying things are great or saying things are not great. So make sure you're aware of that. Make sure you're tracking some of these things. And if you're not sure where to track it, just Google it and find these things and figure out how they affect stocks in different ways. I know I say this a lot, probably gets tired hearing it, but economic indicators are what move markets, not individual earnings reports per stock or some news out about Black Friday. It's the big things. It's the inflation. It's the orders. It's the manufacturing. It's shipping. It's logistics. It's indicators, right? These are what we want to pay attention to. And then just really quick here, earnings for Monday, which I realize I'm late to get to. We heard from Agilent Zoom video today, but on Tuesday, we're going to be hearing from Dick's Sporting Goods, which is DKS, Best Buy, BBY, Burlington Stores, BURL, American Eagle Outfitters, AEO, Dollar Tree, DLTR, all will be out early and before the market tomorrow morning. So if you hold shares in those or you're thinking about it, keep an eye on it. Dell Technologies, DELL, Nordstrom, which is JWN, Autodesk, which is ADSK, HP is HPQ, and VMware, VMW, and Gap as well, GPS, are all going to be after the market close. And the only thing I'm looking at on Wednesday is just Deere & Co., which is DE, and that's going to be before the market opens. So that's what I've got this week, really, that I'm paying attention to. There's not a ton of particular stocks or companies I have my eye on. I'm really more focused on the broad spectrum of economic indicators, what's happening, how these things are changing. But it's more than just whether they come in above or below consensus. What I'm looking to do is understand the long-term trends and directionality of where we're going. And what if you made it this far in the video, I'm gonna drop some real knowledge here and how I've done well over a very long period of time. The key is not to be right on the prediction, okay? The key is not to know the consensus and be with it. The key is not that we hit the mark and you thought so too. The key is to look at the data and find a way to interpret in a different way than the rest of the market, okay? This is where you generate the big returns. This is where you get the differentiated returns. If you can see that the market is trending in a slightly different way than someone else is, or you're gathering data from your own research or combining metrics or indicators in unique ways, and you see something that looks like danger on the horizon, which is going to lead to the Fed having to take action in a bigger or quicker way than they anticipated, you can get ahead of things. So the reason it really matters, okay? You have to start to build your own thesis, your own hypothesis on what you think is happening in the market, what will be done if you're right, and what the result will be if that's the case. It doesn't mean you trade it. It doesn't mean you invest it. But at least in the beginning, start to understand how to blend indicators together. Start to approach financial analysis of these companies, of these indicators, of this data in different ways, just to play with it and see what it would tell you if you back tested it. It is funny, I'm coming way off track here, but assuming you're still watching this video 18 minutes in after hearing about all these economic indicators and stocks that have earnings, look, it's popular to watch videos on cryptocurrency. It's popular to watch about some, I don't even know the word I'm looking for, over-the-counter stock that could 10x, right? Real wealth is built over the long term by doing the right thing, understanding the things that impact your ability to grow your money, and anywhere where you can find an edge by looking at data in a different way, understanding how it flows in a different way, getting your hands to wrangle around the way you want to structure or build your vision of it. That's how you do this. It's about looking at the trends and getting ahead of them, but it's also about recognizing a trend that no one else has yet. It doesn't always mean you have to be right, but it's important to understand how to do this. So with that, I hope everyone has a great week. I hope you have a great Thanksgiving. I would really love a comment below on what you think if you're starting to take in indicators in a different way or looking at signals because you haven't previously done that. I'd really appreciate it. So with that, have a good Thanksgiving. Thanks for watching, and good hunting out there. Thanks, everybody.